So I went to school in Pretoria, Hoërskool Waterkloof, matriculated in 1999. Thanks, sounds like we have someone from that part of the world. Now, usually in South Africa, scholars have got 6 subjects. Now, I was curious. I wanted to find out about all these subjects, not just 6. It felt a bit constraining for me, so I took 13 subjects, 13 matric subjects. And I got distinctions in 12 of them, and a B for the 13th one. So the 13th one was technical drawings. Now, I write with my left hand, but I'm actually right-handed. Don't know if that had anything to do with it, but obviously my technical skills when it came to drawing weren't that good. But I got distinctions in the other 12, which at that time was a record. So I was quite happy, and it fed my curiosity, and I was glad that I could get the very wide exposure to all these subjects. And I think already there was the sign that I would probably go into investments, because if you think about the investment field, one day you're looking at a bank, then you're looking at a manufacturing company, then a services company, then education, whatever it might be. So I think it helps to have a natural curiosity when one then approaches and gets interested in the stock market. From university, from school, I went to the University of Pretoria. Now, I worked really hard at school, so at university, I took things a bit easy. Marks weren't that good. I actually needed to do my accounting third year twice. So I really had a great time at university. Also joined Tux FM, the local radio station. I was a DJ there for 4 years, so that's some of the media exposure that I then later on, it was helpful once again to have some radio exposure when it came to TV. And I had a great time at university. Studied chartered accountancy, and once again, if you want to be a professional in investment markets, I think it's important to understand accounting. You don't need to draw up financial statements, but if you really want to analyze them, read them, understand them, I think a good grounding in accounting or accountancy is quite important, whether it is at school, at university, or then if you want to do a bridging course through an MBA, but get to know the language of business, which is accounting. The first share that I bought was also at university. So while I was at university, Telkom had their listing. And it was a major initial public offering, IPO. There were a lot of ads in the newspaper. It was actually, I think it was 2002, 2003, so the markets actually took a bit of a dip. And in that dip, Telkom wanted to list. And they initially said they want to list at 27 Rand a share. And then as the listing date came closer, they said, no, you can apply for shares at 22 Rand per share. And I thought, well, wow, it used to be 27, now it's 22, the markets are down, this looks like a good opportunity. So I took some of the savings that I had at the time, and I bought Telkom shares at 22 Rand. Those were the first shares that I ever bought. Subsequent to that, the shares did quite well, not because of Telkom, but because of their shareholding in Vodacom. So Vodacom did very well, and it almost disguised the fact that Telkom did not do well. And then later years, they unbundled Vodacom, and then really Telkom lost its way. And it's only in the last year or so that people have a renewed interest in Telkom with the new management team and think that maybe they can get back to their former heights. But that was my first share. So I think Warren Buffett started when he was 7. I started quite a bit later at university in my 20s. Hopefully that won't hold me back too much. For my articles for chartered accountancy, I went and joined the Standard Bank group. I rotated throughout the group, and that gave me a good grounding in banking. So once again, I think I have a good grasp of looking at banks and analyzing banks today because I had a look into how a bank operates from the inside. And that might be the same for you. If you're working and you know the intricacies from the inside of an organization, it helps to then understand it also when you analyze it from the outside. So the different divisions in Standard Bank were very interesting, from global markets research to the insurance division to collections, which was useful then when I had a look at African Bank to understand what collections means, what the department does, etc. And I finished my articles at Standard Bank. During that time, I also studied and got my CFA qualification, Chartered Financial Analyst, and my CAIA qualification, Chartered Alternative Investment Analyst, which once again taught me a bit more about the hedge fund industry, which is where I am today, and very happy because it gives one an extra tool in your toolbox when you're not only looking for shares that look cheap, that you can buy, but knowing a bit how hedge funds operate, it also allows one to short shares and make money when shares fall, which once again in the case of African Bank came to be quite useful. Also in my article period, it was in a finance department where month end is very rushed, you have a lot to do, and then all of a sudden by the 5th of the month, you don't have that much work. So I kept myself busy by reading up on investments because it was my passion. And I found out about this guy, Warren Buffett. And then one of my friends said, no, it's Warren Buffett, 2 T's. So I found out about this guy, who at that point was one of the richest people in the world, all self-made, all through the stock exchange. And I started reading his annual letters. Now, next year, he would have been in charge of the company Berkshire Hathaway, of which he is the CEO and chairman, for 50 years. So that's a long time. That's a lot of annual reports and annual letters to read. But I got through them all up until that time. Like I say, in the finance department, except for month end, it's not very busy. And I even had the opportunity earlier this year to go to Omaha and attend the annual general meeting of Berkshire Hathaway, which was unbelievable for me, one of those bucket list items. Before you kick the bucket, you want to do it. And I really enjoy that, listening to Warren Buffett himself, together with 30,000 other people. But that really also helped me to think about investments the right way. Now, what is the right way? You get traders and you get investors. Now, a trader in anything, it doesn't need to be financial instruments or shares. It can be stock. It could be anything that you buy and you sell. So a trader wants to buy something and sell it for a higher price. And in the middle, they make a profit. An investor wants to buy something and hold on to it for the longer term. And that's the key differentiator, that if one reads Buffett and some of the other people, which I'll get to a bit later, that's the key message that comes through. You need to know, are you a trader or an investor? What is your psychological makeup? What is your preference? What are your strengths? What are your weaknesses? And what does it mean to be a trader versus an investor? And let me tell you, having read all these books and heard about all these guys, there's a lot of billionaire investors. But I still need to hear about all these billionaire traders out there. I haven't picked up many of them. So some of the investors do take some shorter term trades. For instance, George Soros shorted the pound at a time when the pound fell out of a fixed exchange rate versus the European Monetary Union. And through that made a lot of money. That was one trade, but he's still an investor. Most of his money is he analyzes companies or whole economies and decides where is their value, where is there a disconnect between a price of a certain instrument and the actual underlying value. And he takes advantage of those differences. That makes him an investor. So once again, I've got a clear preference to see myself as an investor rather as a trader. And I would suggest to other people that if you're getting into the stock market, you're finding out about it, don't try and be a trader. If you want to be a trader, sure, but whether it's stocks or goods as in a retailer, know that it's all about buying and selling, and you need to give it your full attention. And with stocks that go up and down, your probability of making a profit every time you buy and sell is less than 50%, versus an investor where if you do your analysis and you buy something and you hold on for the long term, your probability is better than 50% if you do it well in terms of making a profit. So understand the difference between a trader and an investor, and I would suggest rather trying to be an investor than a trader. Now, in the stock market, you get a lot of people talking about active investing and passive investing. So if you've made the decision to say, okay, I'm not going to be a trader, I'm not going to sit in front of the screen and buy and sell all day and not really know what the underlying value is. It's all about what's the price now, what was the price a few minutes ago, what could the price be a few minutes from now, and you want to be an investor, a lot of people need to decide, are they going to be an active investor or a passive investor? Now, a passive investor says, I don't have the time to analyze companies in detail. It's not a full-time job of mine. I'm going to buy a basket of shares, the all-share index. You get products, for instance, the Satrix 40, which is a basket of the top 40 shares, the Satrix Divi, which is a basket of the highest dividend-paying shares, the Resi, which is the resource companies, the FINI, the financial companies, the Indy, the industrial companies, and you buy a basket of shares. And you don't spend a lot of time analyzing companies because it's not your full-time job and you're a passive investor. Nothing wrong with that. The best thing anyone can do whose full-time job is not being an analyst and investor is to be a passive investor. You buy a basket of shares, you keep on buying every time you have some extra money, and you just keep on doing that, and the rest takes care of itself. So there's nothing wrong with being a passive investor. On the other hand, if this is your full-time job, as it is mine, a lot of people in the investment industry, you need to justify if you're an active investor. You don't just buy a parcel of shares, a basket of shares. You look at them individually and you decide, I like share number 1 and share number 10 and share number 20, and I don't like share number 17 and 37, for instance. and then it becomes a profession. And unfortunately, it's an indictment on our profession that on average, people in this industry are below average. But they think they're above average. So why are they below average? Because if you take all the investment professionals together, they will get the same as the market return because they are the market, but they also charge fees. So on average, your return, if you give money to every single asset manager out there, will be below average. But each asset manager thinks they are above average, which is impossible. It can't be. It doesn't mean that active management doesn't work. There are a select few asset managers where if you look year after year after year, and maybe not always in a one-year period, but over the longer term, they outperform. They are better than average. And it's something to think about that if you decide, I don't want to be a passive investor and buy a basket of shares, I want to give my money to an asset manager, or I want to choose shares myself, that it can be done. You can outperform. Warren Buffett has shown it. Some other investors have shown it, but it's not easy. So be aware that if you choose an asset manager, you need to be careful, and it's an important decision to look for that above average asset manager. And if you pick shares yourself, it's even a tougher job picking the shares that will perform better than average. So I do believe in the profession, even though it's an indictment that we all underperform, that even though on average we don't add value, individually one can, through good application of the whole process, add value. My best and worst investment decisions so far. So my worst one was probably soon after I entered the industry, looking at a bunch of companies, doing a screen for low PEs and high dividend yields. Okay? And this one share popped up, Alliance Mining. And oh my goodness, it had a PE of 5 and a dividend yield of 10. I must be the only person who found out this share. No one else could know about this. You know, I must have been brilliant. You know, you just do a quick screen, it takes you 5 minutes, dividend yield from high to low, PEs from low to high, boom, there you go. Same company on the top of both lists. And I even went and I phoned up the financial director. Her name was Connie van Nieuwkerk. And at that time, she was actually the financial director of 2 companies at the same time, which is normally a full-time job. That should have been a red flag. But I was fresh into the industry and I didn't pick that up necessarily. Then there were a few other things. For instance, they might have had a 10% dividend yield, but there was almost 6 months from the date which they declared a dividend versus the date when they actually pay the dividend, which would imply that maybe they need an extra 6 months to actually get the money together to pay this dividend, which was another red flag. Then there was another one. Every year they had a new auditor. They went through 4 auditors in 4 years. And once again, I just thought, no, man, don't worry about it. It's not an issue. It's so cheap. It's a high dividend yield, low PE stock. And then went to the website, and it was always under construction. Wasn't quite there. But I read in the annual report that this company does exist, and they do all kinds of fancy things in mining. Apparently, some special cement which you spray on the walls, and it strengthens the mine tunnels. And it was the next best thing. No one has ever thought about it, but this company had this product. So I bought a lot of shares. So my first mistake was not seeing all these red flags. My second mistake is buying too much of the share. So I put in more than 10% of my portfolio in one share. And not too long after that, the share halved. Then I made my third mistake. I bought more because it's even cheaper now. So I had probably about 15% of my personal wealth in Alliance Mining. Not too long after that, the share was suspended, so I couldn't sell the share anymore. It came out that Connie van Nieuwkerk was the financial director of both Alliance Mining and African Dawn. Issues came out in African Dawn, and she was involved in both, so you can imagine there were also issues in Alliance Mining. It came out that the auditors found out things. There are still to today investigations going on. The FSB is still looking at them, but basically those shares are worthless. So that was my worst investment decision ever. My best one, I would probably have to say, is African Bank. Not because it made me the most money personally, or because it was the biggest percentage return, but because it was so public the way we did things, and in a certain sense, we as a company and I stood quite alone in our analysis and our expectation of what could happen versus everyone else. So we were negative African Bank. We said there's a good probability that this company, this bank, is going to go bust. And almost everyone else said, you're mad, this company will be fine. And ultimately, well, even though there are still one or two chapters to be written, African Bank, as we know, is just about worthless today. Now, it's probably important to go through, like I mentioned, the mistakes with Alliance Mining. What were the things that I did right or fell into place for African Bank? So the first thing is, through being in the hedge fund industry, I was open to the idea of looking for opportunities of shares which go down in value, go down in price, and I can make money as the share falls. Okay? So you need to have the hat on of not just looking for value for shares that go up, but looking for value in terms of shares that can go down and being able to short them, which my job and the company I'm with allowed me. A lot of long-only unit trusts, the best they could do is avoid African Bank. We could actually short African Bank. So what were some of the things that we saw that maybe allowed us to have a different insight than other people? So the first thing I must say is, in hindsight, it looks so easy. Everything was so obvious. Even now, you get people say, oh, you should have seen it. Everyone knew African Bank was going to go bust. Very easy to say in hindsight. Not so easy at the time. So a few things, it's almost like a plane crash. For a plane crash to happen, it's usually not just one thing. It's a lot of things that conspire together to create a calamity. The same with African Bank. So the devil here is in the detail. The major issue that we saw that other people didn't see was because of their provisioning policy. They lend out money to people and then they need to provide for those people who don't pay them back. They provision for bad loans. Their policy for providing was not very conservative. They would wait for 3 months for someone not to pay and then only start providing a small percentage of the loan outstanding, and only after more than a year would that ramp up to cover the provision to cover almost the whole amount outstanding. If you compare that to Capitec, the moment they give out a loan, they already have like a 4% provision to say, well, this guy, he just took out the loan, but you know what, there's a small probability that he won't pay it back. The moment you are 1 day behind, they ramp that up. The moment you are 3 months behind, where African Bank starts providing, Capitec has provided in full for that loan. So the first difference was the provision policy, and you only realize that if you went through the detail, read through the annual report, and figured out the difference in the provision policy. The second thing had to do with the funding of the business. So African Bank was reliant on the wholesale market. Every few months they needed to issue bonds, they needed to go cap in hand to institutional investors and say, please lend us money so that we can continue lending money. And that is quite risky if people start seeing that you're in trouble, because every few months you need more money, and if you can't issue more bonds, you can't get more money, well, your cash runs out in the business. It's like the oxygen that gets choked off. So even though you have assets, you have value in the business, without that cash that comes from issuing more bonds, you've got a problem. So their business model was flawed. Thirdly, the business model was also flawed on the lending side. The way that they went to the market, they were the biggest, the most aggressive in extending unsecured loans. They would extend loans to people which, if you think about it, really couldn't afford them. Low income earners. They would do their assessment of affordability by taking almost the whole salary of someone and saying, yes, you can afford an unsecured loan. But the moment something goes wrong, interest rates change, someone loses their job, or there's something happens, for instance, the person needs to buy a new fridge, or they need to pay school fees, or something unexpected, there's not enough income to pay the loan. They were too aggressive in extending the loans. You had a CEO that was not in touch with reality. He always told the market, everything's going to be okay, everything's under control, when the reality showed that was not the case. And he didn't have strong enough people around him and strong enough people on the board to challenge him and tell him, you know what, we see different signs, maybe things aren't going as well as what you think. So there were a number of issues with African Bank. There are a few others, but they're more minor. And I think as time went on, people started ignoring the information that showed that there was an issue, simply because their own incentives were aligned to that. So once you have bought a share, you almost don't want to hear the bad news about the share. It's the human condition. You look for confirmation rather than anything that is opposed to your view. And when it comes to investing, the psychological part of it is extremely important. The moment you buy something, you need to always be open-minded, not even if you buy something, any share you look at, to know the pros and the cons, to be open to hear the bullish case and the bearish case. You need to keep yourself independent in your position, not make judgments too quickly and hear the whole case and think about it very carefully. What is the bull case? What is the bear case? And if you don't master the psychological aspect of investing, your emotions will run away with you. The moment, for instance, you buy a share and it goes down in price, you'll get a fright and you'll think, oh my goodness, the share has gone down. I'm seeing red on the screen. I'm seeing an unrealized loss. I need to sell before it goes down even further. Or the moment the share goes up, I've made a profit, but quickly I need to sell it. I need to lock in the profit. Otherwise, I'm going to lose it again. You need to master your emotions when it comes to investing. And that with African Bank, I think, was also part of the story, also quite important. Then a few learnings. So my personal investment philosophy, the way I look at shares, the way I think about things, analyze companies, has been determined based on what I've learned from other people. I haven't really brought anything new to it. I think there's a song by the Bare Naked Ladies. It's all been done. So investments, there's so much written on the subject. There's so much that people have tried. It's all been done. What you can do to add value or to make yourself stand out is maybe to combine a few of these thoughts. In isolation, they're useful, but combined, they can really make you money, I would say. And some of these are the following. So the first one is Benjamin Graham. They call him the father of value investing. He wrote a book, The Intelligent Investor. He was a professor at Columbia University. Warren Buffett attended his classes and learned from him himself. And he came up with the concept of Mr. Market. So remember when I spoke about the psychological aspect? He used the analogy of Mr. Market. There's a schizophrenic guy that you are in business with. And you and him own a business together. And every day, he would either come to you and say, I want to buy you out, and he would offer a certain price for your half of the business. Or he would say, I'm scared how things are going at the moment. I want you to buy me out at a certain price. And you need to be okay with dealing with this guy every day. The one day he wants to buy, the one day he wants to sell, but every day it's a different story. The same with prices on the stock exchange. The one moment they're up, the next moment they're down. You need to decide how you're going to deal with that feedback you get the whole time. Imagine someone tells you the value of your house every day. I'm telling you now, your house doesn't go up in value every day. And some days your house would go down in value versus the previous day. But thank goodness no estate agent tells us every day. It would probably drive us mad, especially if you know there's a bond against your house. And at some point you go into negative equity. So thank goodness we don't know that. So you need to master Mr. Market, the psychology and the impact of knowing prices every minute of every day. It's a benefit because it makes us in touch with all the data that's going on there, but it can be a negative if you get carried away with it. You know, the stock market is very accessible to just about everyone, not just professionals, but anyone can open a brokerage account. Anyone can see share prices minute to minute, second to second, can click on a buy button or a sell button, and it's great in some respects, but it is a double-edged sword because very easily you can get carried away by the instant feedback of Mr. Market. Second one, Warren Buffett. I've learned so much from reading just about anything he has written or any interviews, etc. Basically what he has said is you need to buy with a margin of safety. You need to buy something which might be worth R1, but you can buy it at 50 cents. Now, that's quite a fuzzy concept. And the extra bit that he brought to it, which his professor, Benjamin Graham, did not, is to say, well, there are two ways to decide there's a difference between the value of something and the price of something. The one is you can see today, there is an asset, it's worth R1, but I can sell it or buy it at 50 cents. So there's a difference. The other one is value through growth. So this asset might only be worth R1 today. I can buy it for R1, but you know what? This asset is going to grow in value quicker than average. And what assets grow in value quicker than average? Great companies. So great companies compound their profits, grow their profits at a higher than average rate. And therefore, Buffett came to the conclusion that you should be willing to pay a reasonable price for a great business if you expect the profits of the business to grow at an above average rate. So while Benjamin Graham looked for what he called cigar butts, something that's cheap today, it might be a terrible company, but you can sell all the assets today and get more than the price you paid for it, Warren Buffett says there's more value actually in growth. Go for great quality companies, ignore low quality companies, and even if you pay up closer to the fair value today, the quality of the company will make that fair value increase at an above average rate. The third person is Warren Buffett's vice chairman and his friend for just about 50 years, Charlie Munger. Now, Charlie Munger has one of the sharpest minds, not just in investments, but of anyone that I've read anything about. He wrote a book called Poor Charlie's Almanac, which is a type of taking a tongue-in-cheek stab at Poor Richard's Almanac, which was written by Benjamin Franklin years ago. But Charlie Munger thinks about things in the most logical way you can think of. Every time Warren Buffett is unsure about something, he would phone Charlie Munger. And Charlie Munger would very quickly get him on the right track and give him a very realistic answer. Some of the things that Charlie Munger has said is, look for Lollapalooza effects. That means when a bunch of things conspire to give an enormous impact. As African Bank, and you get a few others as well. For instance, an avalanche, for it to happen, you need a bunch of things for the snow to move all at once. So look for companies or investment decisions that you can make where there's a bunch of small things that come together which can lead to an enormous outcome. That also speaks to derivatives. A lot of derivatives, options, you pay a premium, and if things go your way, the payoff you get is a multiple of what you paid. So you leverage your profits if the outcome is as expected. You also get a type of derivative called a future or a CFD, which is leveraged the same both ways, and once again, it's a double-edged sword. If you're right, you make a multiple of what you put in. If you're wrong, you lose 100% or even a multiple of what you put in. So be very careful of leverage. And Charlie Munger warns against that as well. If you can find anything written by Charlie Munger, I suggest give it a read. One of the best brains out there. Next one, George Soros. So Soros is a bit closer to a trader, but he still analyzes companies and he's still an investor, I would say. And he came up with a concept of reflexivity. Now, reflexivity is also a special case where you have a company and its share price impacting its fundamentals. So usually you have the company and what it does, and you have the share price, and the two aren't linked. But sometimes you get an interaction between the two. And I'll give a local example, a company called Caro. You have an education company, which has an anchor shareholder in the PSG group. Through having an anchor shareholder, the share price, some would say, are artificially high, but the high share price allows them to do rights issues, to issue more shares at a higher price, which allows them to buy more other schools, which becomes a virtuous cycle because then the earnings grow, they issue more shares, the market likes the increased earnings and pushes up the share price, then they issue more shares, they buy more schools, they grow their earnings, etc. So you get these virtuous cycles. You also get it in property. A lot of property companies issue their shares to buy other properties. The higher the share price, the more accretive deals they can do. It accrues to their profits. So look out for these special reflexivity examples where a price actually influences the fundamentals. While usually those two are disconnected, sometimes they are connected. Jim Rogers, he was a partner of George Soros when they started the Quantum Fund, and what he brought to the party is two things. Firstly, he traveled widely. He actually took a motorbike and went around the whole world. He's in the Guinness Book of Records for that. So this guy has been almost everywhere. That gave him special insight, understanding if you are investing globally, how do other cultures, other economies, other places work. And with that insight, you can make better decisions than other people. The second thing is, he really did his homework. He not only read annual reports of companies, he got trade journals, and he read every single thing of a company, whether it's the annual report, it's a competitor saying something, it's a trade journal. He got as much information as possible. So if you want to be successful in investing, you need to put in the hard yards, you need to put in the hours and read as much as you can about a company. Most of my day is spent reading, and reading. Then I think about what I've read. And every now and then I might actually do something about it. I might buy something or sell something. But reading is the principal activity when it comes to investing. Michael Steinhardt. He retired, so he was a hedge fund manager in the US. The great track record. He compounded at more than 25% per annum over more than 15 years. And he came up with the idea of variant perception. All that means is you need to be able to look at the same set of facts than someone else, but come to a different conclusion. So once again, in African Bank's case, The facts were there for everyone to see, but not everyone came to the same conclusion. And it ties up again with this psychology. You need to be comfortable to disagree with other people, to disagree with the majority of other people. And you might get criticism for it. You might doubt yourself. But you need to be, I wouldn't say pig-headed about it and be different just for the sake of being different. That's being contrarian, it's called. But sometimes be the same as the majority, sometimes be different to the majority, but have your own independent thought and come to a variant perception while looking at the same facts as anyone else. Seth Klarman, also a very astute hedge fund manager who still operates. Also a few interesting concepts that he brought to the table. One of them is, he says an investor needs to have a good balance between arrogance and humility. If you buy a share, that's quite an arrogant thing to do. Because on the other side, there's a seller if you're buying. You're saying at this price that me and the seller agree at, I know more than the seller. I'm going to buy the share. And I know more than the guy who's selling me the share. That's quite arrogant. On the other hand, you need to have the humility to say, well, I could be wrong. Maybe the seller knows more than me. Maybe I'm making a mistake. And you need to have this natural tension between arrogance of trading in the markets, if you're trading for an investment, and being humble, knowing that at any point in time you can be wrong. The future is inherently uncertain. We don't know what's going to happen tomorrow. We can't even predict the weather a week from now accurately. What about the stock exchange? Who knows? And you need to have that natural tension. Next person, Peter Lynch. Peter Lynch was, we call it a unit trust manager. In the UK, it's called a mutual fund manager. Also, one of the best track records he had when he retired. He managed the Magellan Fund, it was called. And he said he never found a stock he doesn't like. He had more than 100 shares in his portfolio. And the shares that he really liked were the ones that, whether it's in the week he's at the office, or it's over the weekend he's with his wife in the shops or traveling, he can see the company. He can see what the company does, and he can understand the company because it's simple. And he thinks that even people who aren't in the profession can analyze companies by following the type of companies that they like in terms of the type of services that they would prefer or the type of goods that they would prefer. So if you have a preference for a certain bank or a certain service provider, that could be a source of a good investment idea. Because if you like it, chances are other people like it. And if everyone likes it, they're probably going to win more clients, they're going to grow their revenues, and if they do a good job internally, they're going to grow their profits as well. So always be on the lookout, whether it's in the week or in the weekend, for a stock that you might like. And then the final person of some of the greats I've put up there is Joel Greenblatt. Now, he came up with this concept, and he wrote a few books, but the one that was quite good is The Little Book That Beats the Market. And in it, he talks about two concepts that, when combined, gives one a better than average outcome. The one is return on capital, and the other one is the PE ratio. So on the one hand, he said, I still want to buy shares cheap. I want a lower than average PE ratio when I buy. But I also want higher than average quality. So I want the return on capital of this business to be above average. So if the company's return on capital is above average, it means they've got some pricing power, they've got some moat, some competitive advantage, which allows them to generate a return above the cost of capital and above their competitors. That's an indication of higher than average quality. And if you combine that with a company trading at a lower than average PE, you have a quality company at a fair to cheap price. Now, these are rules of thumbs. So it should come with a health warning. You can't just buy a company based on a low PE. Remember Alliance Mining? You can't just buy a company based on a higher than average return on capital. You don't know, is it once off? Is it structural? You need to understand what the company does. When you see shares, whether it's a list in the newspaper or it's on your screen, on your computer screen, there's a company behind it. Understand the company and think about the quality of the company. And think about the returns on capital of the company. If it's above average, it's a good quality company. But a share is only a reflection of an underlying company. That's where the analysis should be, about the company. That's about it. I've specifically left some time for questions. So if there are any questions, please feel free. Yes. Sorry, yeah.
Can you hear me?
Yes.
When you were describing how you saw Abel, you said that the CEO was out of touch with reality. What made you think that, or what was? It sounds like a perception. How did you make that assessment?
So the first thing is, when the bad news came out, they had a few results presentations and other public events after that. And the first thing is, you can see by his body language, he was a very charismatic person. And he put a positive spin on everything that had happened to African Bank up until that point. And he always saw the glass as half full based on the things that he said. Also, when things got really bad, and for instance, they needed to sell Ellerines because it became a albatross around their neck, it drew capital from them, he indicated to the market that it would be a positive for them to sell Ellerines. Having done the analysis, we came to the conclusion that Ellerines had a negative value, because most of the worst quality loans that were written in African Bank were actually through the furniture stores of Ellerines. And if you look at the capital position of African Bank and the fact that Ellerines was loss-making, we did not see that anyone would be willing to buy Ellerines for a positive number. They would need to be paid to take over Ellerines. So by him saying that it would be a net positive to sell Ellerines, while our analysis showed it would be another drag on the capital of the business, was another indication that he was out of touch. Up until the very last announcement in the week that the share was suspended, if you read through their SENS announcement and you look through their slides, they focused on how much cash came into the business versus cash going out, so repayments versus disbursements. That doesn't tell you the true story. It's about what are the write-offs that are happening in that, because for regulatory capital, it's not just cash in, cash out. Your bad debts that gets written off is a deduction of capital. And the way that the tone of the SENS announcement came out, it implied that they themselves either did not understand it or didn't want to realize the fact that you can't look at your regulatory capital and whether you have enough by just looking at cash in, cash out. You need to think about your write-offs. And in that announcement, they mentioned an extra 3 billion rand write-off. So there were a few little signs to show that he was out of touch with reality, which it seems like was the case. So there are two ways to short a share. You can either do it directly by borrowing the shares from someone who's a long-term holder and is willing to lend out the share because you pay them something to borrow the shares. And at any point in time, they can recall their shares, so it almost costs them nothing to lend out the share because they can get them back at any time. But in the meantime, they make a few percent, 3, 4, 5% because they've lent out the share. It's very normal to lend out shares. There's nothing wrong with it. It happens all around the world. It helps those long-term holders who want to get a few percentages. It helps people who want to short shares because they think it's not trading near fair value, and it allows prices to converge closer to fair value. So I think shorting is very healthy. In South Africa, we can't do naked short selling. You need to borrow the shares first before you short. In some markets overseas, you can short shares that you haven't borrowed, called naked short selling. Then you can keep on shorting shares, and you can effectively overpower buyers because you can short more shares than what they are actually in issue, that they are in existence. I don't think that's healthy. But South Africa has got only covered short selling regulations, which is good. The second way of shorting a share is that you let someone else borrow the shares, write a derivative like a CFD or a single stock future, and you trade that with them. That way brings counterparty risk into it. So the way that we always short our shares that we do short is we borrow the shares and we sell them in the market. We do directly without a counterparty, without a derivative, because doing it via derivative brings in counterparty risk that maybe things are great, but as we saw in the case of Lehman Brothers, maybe something goes wrong, and we'd prefer not to take counterparty risk.
Hi. I have a question here. For someone who is young, would you advise that perhaps he blindly invest on your private equity funds like Coronation, Allan Gray, or Cetrix 40, as opposed to your retirement annuities, taking into consideration the returns?
So there's a few regulatory changes happening currently, because the major difference between the unit trusts you mentioned and via a retirement annuity is there are tax benefits if you invest via a retirement annuity, but what the state gives, they take away. So you get a tax benefit, What you then don't get is you can't access that money again. And there's are sometimes special rules for provident funds that you can access a portion. But for all purposes, the moment you put a money in a retirement annuity, you get a tax benefit, but you can't pull out the money until you retire. Okay. Most retirement annuities these days allow you to still choose those asset managers via a retirement annuity. So the money ends up in the same place. The question you need to answer is, do I want access to the money and then I need to pay tax on my income before investing in the unit trust? Or is this for my retirement? And then you're very happy to get the tax benefit invested via retirement annuity, still with an asset manager that you prefer, having done your analysis and whoever you like, and it ends up in the same place, but more money ends up there because you get a tax break. So it's pre-tax money that gets invested. So for a young person that probably doesn't have a lot of assets, that needs to build up a pension for the long term, I like the idea of getting a tax break and investing it with still one of those asset managers. One of the changes in regulations coming in is tax-efficient savings accounts that will probably come in next year, where an amount of up to 30,000 Rand every year, you can direct the way you want to your asset manager, and you can access it in the short term. And you get a tax break by putting it in today, but the moment you draw it, you then pay tax. So it's almost like a retirement annuity, but with the benefit that you can access it between now and your retirement age. That will probably come in next year. So for now, retirement annuities are great. When the personal tax savings accounts come in next year or soon thereafter, that might be even better as long as the tax benefit is there, but that's to a maximum of 30,000 Rand per year, which if you're starting out is fine, but you might reach a cap at some point, and then you might want to do it directly, pay the tax, but now you can access that money in case of some emergency. So the question was about fees. With passive management like the Satrix 40, you can invest, and the fees are very low, 0.6%. If you go with an active manager, the shares are, the fees are quite high. It could be 1 to even 3%. And I can tell you, for instance, our firm, 361, we have quite high fees. We have above average fees. And people look at the fees, and they say, oh my goodness, 0.6 versus 2 or 3%. Now I'm going to go for the 0.6. It's almost like thinking about a doctor or a lawyer and saying, I want the cheapest doctor or the cheapest lawyer. Not all outcomes are going to be the same. If you go for the cheapest doctor or the cheapest lawyer, maybe the skill won't be the same and maybe the outcome won't be as great. It's not always the case. You get bad asset managers who charge high fees. But you also get good asset managers who charge high fees. I don't think you get good asset managers who charge low fees. I don't think you get that. So the point is, I would say fees are important because all other things equal. If you go into the same investment with a high fee and a low fee, the low fee investment will do better, but all other things aren't equal. So you obviously don't want to go with any investment manager that you think the fees are excessive. And the higher the fees, the greater the skill needs to be to offset the fees and still give you a better return. But those managers, I would say, do exist, and our track record after fees on the funds we manage are still above the market returns, even after charging higher than average fees. So don't focus too much on fees, rather look at returns in the past after fees. And all unit trusts, when they disclose returns, must disclose it after fees. So rather look at returns after fees versus fees in isolation. Yes?
How did you make your money look able? So what was the strategy that you used?
So African Bank and the media exposure that came with it. Sorry, for the webcast purposes, the question was, how did we make money? What was the strategy around African Bank? The reason it came out in the media was an off-the-cuff remark I actually made to a Bloomberg journalist, and all of a sudden it became a story all about the biggest hedge fund in South Africa versus African Bank. But actually, African Bank was just part of our portfolio of shares that we hold. So at any point in time in our hedge funds, we could have 30 or 40 long positions, shares we like that we own shares in, and we could have 10 or 20 short positions. And our short positions are not in shares that we think, oh, all these companies are going to go bust. It could be good companies that we think are expensive. It could be mediocre companies that we think are going to deteriorate in their profitability. And in this case, it was a company we thought there was a chance they could go bust. So African Bank wasn't a strategy on its own. It was part of our normal portfolio management of having a diversified portfolio. We had 2% short in African Bank. It made us 100 million Rand for our funds and therefore for our clients, okay? But we manage over 10 billion. So in the context of the 10 billion, it added 1% in that last month to our return. It was not a Hail Mary trade. It was not all about African bank in isolation. It was just part of a diversified portfolio, and it added 1% to our return for that month. Because it was before that a 2% position, but for that month at the end when it fell, it was a 1% position. Yes?
Which fund manager do you have the most respect for right now?
Okay, so the question is, which fund manager do I have most respect for currently? In South Africa? Sure. Look, this is going to sound like I'm talking my book, but I must say the team we've gotten at 361, we've got a guy called Evan Walker. Before he joined us, he ran the Momentum Small Mid Cap Fund. A few months before he joined us, he was the #1 unit trust over 10 years, 7 years, 5 years, 3 years, 2 years, 1 year, 6 months, and 1 month in the country. Okay? That has never been done as far as I know. So Evan Walker as an individual, I have a lot of respect for, and he works for us. So that's the first individual that comes to mind. Then I must say that all of us in this industry, we all bump into each other when we go to the analyst presentations, etc. And all of us are clever, if I can put it that way. We've all got university degrees and postgraduate qualifications. There are sharp guys in this industry. You can't be in this industry for too long if you're not sharp, okay? But we all make mistakes. We're just human. So there's no one I would say, wow, that person never makes a mistake or he just makes the right calls. None of us can say that. So I have respect for everyone in the industry, but I put no one on a pedestal because I don't think anyone would justify being on a pedestal. So the question is about the retirement reform that's currently happening, what the rules might be, and a lot of people in government specifically are resigning in order to access their pension so they can do something with the money. They pay tax when they do that, but they feel safer doing that knowing where the money is and that they can access the money again versus not doing that, and then it goes into a system where the rules are going to change. Now, I'm not on top of all the rules in detail. What I would say is what it comes down to is the government wants to preserve pensions for longer and doesn't want people to access pensions before they get retirement age, because what we have seen is if you allow people to resign and access your pension, even if you pay tax, that doesn't seem to be enough of a penalty because people still do it. And they spend their money. And then by the time they get to retirement age, they don't have enough money to retire on. And unfortunately, that is the case in South Africa and in most countries, that most people that reach retirement age actually don't have enough money to retire. And they then become indebted to society, to their children. They live on old age grants, for instance. And through that way, it's not a healthy system. It would be healthier if people throughout their lifetimes, as they earn money, can contribute to a retirement fund. Then they are not allowed to access that money. And only at retirement age, that would give them a greater probability of having enough money to retire on. So a lot of people are nervous because for now you can still access some of your money if you resign. Those rules will probably change that you cannot access your money. And on the one hand, it is a pity because a lot of the time you do have an emergency and people see their retirement money as a source of money in case of an emergency. But it is not really. And a lot of times there could be a plan B or C, but people don't want to do plan B or C. They want to access the retirement money, but that leaves a bigger problem later at retirement age. So I don't have an answer for you. What I would say is I like the idea of pension preservation, and there's going to be greater preservation. You can't access your money before retirement, but it does create a problem if people have an emergency between now and when they retire. Where can they find some funds? Because they can't access their retirement, which they can today, when the rules change. Then they won't be able to. So it's a tricky question. So one of the things I mentioned when I spoke about Jim Rogers is the amount of reading and the information, etc. And the one thing that I've learned in this industry as well is that everyone's got an opinion. Everyone has got a tip they want to give. But part of the psychological makeup that one needs to have is standing independently and not making decisions based on other people's opinions. So in the profession, that is the case. But it is a bit trickier if you're not in the profession and you want a tip from a professional. What do you do then? The problem from our side is, right now, I might have top 3 shares in my mind that I like and top 3 shares that I would short, but share prices move, the company's prospects change, and then I can't phone you in a month and tell you that I've changed my mind. And then if you are still holding those shares and things change and they go down in price, then you're not very happy with me. So that's why I steer clear of giving stock tips. Or when I do, it always comes with a health warning of saying, this is what I feel right now, but it could change tomorrow. What I would say in general, we've had a bit of a market correction so far. In my opinion, so this is my opinion, it's not necessarily true, I still find it difficult to find shares that offer value. So I'd be very happy not to buy anything currently. And even though cash is giving a low return, cash is also the potential for return later. And by having cash today, it allows you that if things get really bad, to then buy shares really cheaply, and your return would be better. So don't feel like that money is burning a hole in your pocket. You have to buy something every day, or every day there's an idea, there's something worthwhile buying. Maybe there isn't. And I think currently we're in that time where there's nothing for me personally that I feel like, wow, I want to own that share. Commodity companies, by definition, are more variable because they don't have any pricing power. The price at which they sell their product at is based on the market price, and it's a global market. And we mine platinum here, Zimbabwe mines platinum, Russia mines platinum, and who knows what's going on in Russia. And you can't ask a premium for your product. Platinum is platinum. So because of that, forecasting when it comes to commodity companies is more treacherous than any other sector because of this uncertainty, because you don't know what's happening with the revenue line. So I don't have a firm view on Impala because I know the outcome is more variable. You could have, let me give you two scenarios. You could have environmental legislation scrapping all cars that don't have catalytic converters, leading to a surge in the production of catalytic converters, which uses platinum, which draws platinum from the market. In conjunction with that, you have political turmoil in Zimbabwe, and you have the West imposing sanctions on Russia. The price of platinum goes through the roof. Implats can sell their platinum at great prices, and they make a lot of money. There's another scenario, and that is that there's so much other issues going on in the world. The environmental issues aren't that much of a priority. You have a lot of cars being scrapped and platinum being recycled from old catalytic converters. People don't want to buy new platinum supply. Zimbabwe keeps on producing. Russia keeps on supplying. The price goes even lower, but the mines have got cost pressure, electricity increases, labor disruptions, and their costs go up. And you have that negative jaws of increasing costs and decreasing revenues. And then you have the profitability and therefore the share price going even lower. And I leave it to you to work out the probabilities of those two scenarios. Cool. Thanks, everyone. That was a lot of fun. Hope it was useful to you too. Thanks, David.